What if I told you that the most powerful financial institution in America, the one that controls interest rates, prints money, and decides whether you keep your job during a recession, isn't actually part of the government? Here's the thing. Nobody wants you to understand. The Federal Reserve, created in 1913, is a private banking cartel dressed up as a public institution. It was born in secrecy on Jekyll Island, Georgia, where 6 men representing 1/4 of the world's wealth met in the dead of night to design a system that would make them richer every single day you went to work. You feel it, don't you? The paycheck that doesn't stretch as far, the mortgage that never seems to shrink, the credit card minimum payment that somehow keeps you in debt for decades. That's not an accident. That's not bad luck. That's the machine working exactly as designed. And the wildest part? They convinced you it was necessary. They called it the Federal Reserve to make you think it was yours. But it never was. Before we go further, drop a comment and tell me where you're watching from. I want to know how far this message is spreading. And if you're ready for the unfiltered truth about how money really works, hit that subscribe button. Because what comes next will rewrite everything you thought you knew about American finance. Let's start with the official story, the one they teach in economics classes. In 1913, Congress passed the Federal Reserve Act, creating a central bank to stabilize the economy, prevent bank runs, and manage the money supply. President Woodrow Wilson signed it into law on December 23rd, 2 days before Christmas, when most of Congress had already left Washington. The goal, they said, was to prevent the kind of financial panic that had rocked the country in 1907. Sounds reasonable, right? Responsible, even. But here's what they don't teach. The 1907 panic wasn't a natural disaster. It was triggered by a failed attempt to corner the copper market by a group of wealthy bankers. When their scheme collapsed, they pulled their money out of banks, creating a liquidity crisis that threatened the entire financial system. The man who saved the economy, J.P. Morgan. He handpicked which banks would survive and which would fail, consolidating power in the process. Sound familiar? Fast forward to 2008. The subprime mortgage crisis, another manufactured disaster created by reckless lending and financial engineering, brought the global economy to its knees. Who stepped in to decide which institutions were too big to fail? The Federal Reserve. They created trillions of dollars out of thin air to bail out the same banks that caused the crisis, while millions of Americans lost their homes, their savings, their futures. The playbook hasn't changed. Create the crisis, offer the solution, consolidate the power. But let's go back to how this began. In November 1910, Senator Nelson Aldrich, whose daughter was married to John D. Rockefeller Jr., organized a secret meeting. The attendees traveled under aliases to Jekyll Island, a private resort off the coast of Georgia. For 9 days, 6 men representing the Rockefellers, Morgans, Rothschilds, and the largest banks in America drafted legislation that would become the Federal Reserve Act. These weren't elected officials debating policy in the public interest. These were private bankers designing a system to protect and expand their own wealth. They even wrote the law to make it sound like a government agency. Federal Reserve. Board of Governors. Chairman. All the language of public service, hiding a private monopoly. And here's the kicker. The Federal Reserve is owned by its member banks, not by the government, not by the people, by the banks themselves. They elect their own regional presidents, they set their own policies, and they profit from every dollar of debt created in this country. Sound familiar? Today, the Fed's balance sheet exceeds $7 trillion. During COVID-19, they created more money in 6 months than existed in the first 200 years of American history. Where did that money go? Mostly to financial institutions and corporations through asset purchases and loan programs. The stock market soared. Real estate prices exploded. But your grocery bill? That doubled. Your rent? That went through the roof. The mechanism is the same. Privatize the profits. Socialize the losses. But here's what makes it truly diabolical. The Federal Reserve doesn't just print money and hand it out. They use a system called fractional reserve banking to multiply every dollar they create by 10, 20, sometimes 30 times. And that multiplication happens through debt. Your debt, your mortgage, your car loan, your credit cards. Here's how it works in the simplest terms. When the Fed creates $1 and deposits it in a commercial bank, that bank is only required to keep a fraction, say 10% in reserve. They can loan out the other 90 cents. When you borrow that 90 cents and spend it, it gets deposited in another bank. That bank keeps 10% and loans out the rest. This cycle repeats over and over, turning $1 into $10 of debt circulating through the economy. Sound familiar? Every time you hear politicians talk about stimulus or quantitative easing or emergency lending facilities, this is what they're doing. They're multiplying debt, inflating asset prices for the wealthy, and diluting the value of every dollar in your pocket. The rich get richer because they own the assets that inflate. You get poorer because your wages don't keep up. And the Federal Reserve, they take a cut every step of the way. Member banks earn dividends from the Fed, currently set at 6% annually, no matter what happens to the economy. When the Fed profits from its operations, those profits go first to the member banks, then whatever's left gets sent to the Treasury. You work, they profit. That's the deal. Now here's where it gets even darker. The real genius of the 1913 deal wasn't just creating a private central bank. It was making that bank the ultimate backstop for every risky bet the banking system wanted to take. Before the Federal Reserve, banks that made bad loans went bankrupt. Simple, brutal, effective. If you loaned money to someone who couldn't pay it back, you ate the loss. This created a natural check on reckless behavior. But the Federal Reserve changed the game entirely. Suddenly, banks had a lender of last resort. If they made bad loans, they could borrow from the Fed to cover their losses. If they faced a bank run, the Fed would inject liquidity. If they gambled on risky investments and lost, the Fed would step in with emergency credit. This is called moral hazard, and it's the foundation of modern finance. When you can't fail, you take bigger risks. When you take bigger risks, you make bigger profits, until you don't. And when you don't, someone else pays the bill. The man who understood this better than anyone was Paul Warburg, one of the 6 bankers at Jekyll Island. Warburg had studied European central banking systems, particularly the Bank of England and the Reichsbank in Germany. He knew that a central bank could stabilize currency and manage credit, but he also knew it could be weaponized to concentrate wealth. In a 1907 essay, written the same year as the banking panic, Warburg laid out his vision: a united reserve bank that would hold the deposits of all other banks, issue a uniform currency, and control the money supply, not to serve the public, to protect the banking system from its own excesses. That's what the Federal Reserve became. A legal cartel that lets banks privatize profits during booms and socialize losses during busts. And the American people? They're the ones holding the bag every single time. But here's the part that should terrify you. The Federal Reserve Act gave this private institution the power to set interest rates, control inflation, and determine the value of the dollar, all with zero direct oversight from Congress or the President. The Fed chair testifies before Congress, sure, but the Fed's decisions can't be overruled. They can't be audited for monetary policy. They operate in the shadows, by design. And when you look at who's actually benefited from the system over the last 112 years, you won't believe the name on top of the list. You won't believe how much wealth has been transferred from the middle class to banking dynasties in plain sight. The receipt is wilder than you think. Let's break down exactly how this wealth transfer machine operates. Because once you see the mechanics, you can't unsee them. Stage 1, money creation through debt. The Federal Reserve doesn't print physical cash anymore, not really. Most money today is digital, created with a keystroke. When the government needs to spend money it doesn't have, the Treasury issues bonds. The Federal Reserve buys those bonds, crediting the government's account with newly created dollars. This is debt-based money creation. Every dollar in circulation is someone's liability, either the government's, a corporation's, or yours. The money supply only grows when debt grows, and the debt only grows when someone borrows. But here's the trap. The money to pay the interest on that debt doesn't exist until someone else borrows more. It's a perpetual treadmill. The economy must constantly expand, constantly create new debt, or the whole system collapses. Between 1913 and 2025, the U.S. national debt has grown from $2.9 billion to over $36 trillion. That's a 12,000-fold increase. Meanwhile, the Federal Reserve's balance sheet has grown from virtually nothing to over $7 trillion, and total private debt, mortgages, auto loans, credit cards, student loans, exceeds $25 trillion. Add it all up, and you're looking at more than $68 trillion in total debt in the U.S. economy. That's money that was created from nothing, loaned into existence, and now must be paid back with interest to the banking system. Stage 2, fractional reserve multiplication. Now let's talk about how that debt multiplies through fractional reserve banking, because this is where the real theft happens. When the Fed creates $1 billion in new reserves and deposits it in commercial banks, those banks don't keep it in a vault. They're required to hold only a fraction, historically 10%, though since 2020, the reserve requirement has been dropped to 0%. Zero. Let that sink in. Banks can now loan out 100% of their deposits, creating money out of thin air with no meaningful constraint except capital requirements, which are laughably easy to game. Here's a real-world example. In 2008, Lehman Brothers had $639 billion in assets, but only $22 billion in equity, a leverage ratio of 29 to 1. For every dollar they actually owned, they had borrowed $29. When their bets went bad, the entire firm collapsed in days. But the bigger banks? They were bailed out. Bank of America, Citigroup, JP Morgan, Goldman Sachs, they all received direct bailouts, cheap loans, and asset guarantees from the Federal Reserve. The total support provided during the 2008 financial crisis exceeded $7.7 trillion according to a 2011 Bloomberg investigation. That's more than half of the entire U.S. GDP at the time, created from nothing and handed to the institutions that caused the crisis. And what happened to the bankers who made those reckless bets? Many received bonuses. Not one major banking executive went to prison. The system protected them because the system was built for them. Stage 3, interest extraction and wealth concentration. Now, here's the most insidious part: interest. When money is created through debt, the interest on that debt must be paid back. But the money to pay the interest was never created. This creates a mathematical impossibility. There's always more debt than money in existence, which means someone must always default. The game is musical chairs, and the music never stops. Who benefits from this system? The creditors, the banks, the financial institutions that own the debt. And who loses? Everyone who owes money, which is almost everyone. Let's look at the numbers. In 1913, the top 1% of Americans controlled about 18% of the nation's wealth. By 2024, that number had grown to over 32%. Meanwhile, the bottom 50% of Americans now hold just 2% of the wealth, down from 4% in the 1980s. Where did that wealth go? It didn't evaporate. It was transferred, systematically and legally, through a financial system designed to extract value from workers and concentrate it in the hands of capital owners. Consider the average American household today. They carry $155,000 in debt, according to 2023 data. $220,000 in mortgage debt for those who own homes, $23,000 in auto loans, $6,000 in credit card debt, and $58,000 in student loans. Every month, a significant portion of their income goes not to building wealth, but to servicing debt, paying interest to banks. And those interest payments, they flow upward to bondholders, investors, and financial institutions, the same entities that benefit from the Federal Reserve's policies. Stage 4, inflation as hidden taxation. But it gets worse, because there's another mechanism at work here: inflation. When the Federal Reserve creates trillions of dollars out of thin air, the value of every dollar already in circulation decreases. This is basic supply and demand. More dollars chasing the same goods means higher prices. Inflation is a hidden tax, and it disproportionately hurts the poor and middle class. If you own assets, stocks, real estate, businesses, inflation makes you richer because your assets appreciate in nominal terms. But if you're living paycheck to paycheck, inflation destroys your purchasing power. Since 1913, the US dollar has lost over 96% of its purchasing power. What cost $1 in 1913 costs over $31 today. That's not random. That's the deliberate result of a monetary system designed to expand the money supply and devalue the currency. And who benefits from that devaluation? The debtors, specifically the biggest debtor of all, the US government. When you owe $36 trillion, inflation is your friend. You pay back your debts with cheaper dollars. But for savers, for wage earners, for anyone holding cash, inflation is theft. It's a transfer of wealth from those who work for money to those who own money. Stage 5, the shadow banking system and derivatives explosion. Now let's talk about the shadow banking system, because this is where the Federal Reserve's creation has metastasized into something truly monstrous. In addition to traditional banks, there's a massive network of non-bank financial institutions, hedge funds, private equity firms, money market funds, investment banks, that operate outside traditional banking regulations, but benefit from Federal Reserve backstops. These institutions engage in what's called rehypothecation, which is a fancy word for using the same collateral multiple times to secure different loans. It's fractional reserve lending on steroids. And then there are derivatives, financial instruments whose value is derived from underlying assets. Derivatives are used to hedge risk, but they're also used to speculate, to leverage, and to hide risk from regulators. The global derivatives market is estimated at over $1 quadrillion. That's $1,000 trillion in notional value. Most of that is concentrated in the hands of a few dozen massive financial institutions. And when those bets go bad, guess who steps in to provide liquidity? The Federal Reserve. In March 2023, when Silicon Valley Bank and Signature Bank collapsed, the Fed created a new emergency lending program, the Bank Term Funding Program, that provided up to $2 trillion in credit to banks facing liquidity crunches. No debate, no vote, just instant creation of money to protect the system. This is the endgame of the 1913 deal. A financial system so large, so complex, and so interconnected that it's become too big to fail. The banks know it. The Fed knows it. And they use that knowledge to take ever larger risks, knowing the American taxpayer will be forced to bail them out. The smoking gun. Who profits? So who actually owns the Federal Reserve? That's the question no one in power wants to answer directly. The Federal Reserve is technically owned by its member banks, which include JP Morgan Chase, Bank of America, Citigroup, Wells Fargo, Goldman Sachs, and Morgan Stanley. These banks own shares in their regional Federal Reserve banks and receive dividends, set at 6% annually until 2016, when it was changed to a formula based on the 10-year Treasury rate. But the real power lies in who controls the policy. The Federal Reserve Board of Governors, appointed by the President and confirmed by the Senate, sets monetary policy. But the regional Federal Reserve banks, owned by private banks, elect their own presidents, who vote on the Federal Open Market Committee, the body that actually sets interest rates. It's a carefully designed system of plausible deniability, public enough to seem legitimate, private enough to avoid accountability. And the result? A century of wealth extraction on a scale never before seen in human history. Between 1989 and 2023, the wealth of the top 1% grew by over 400%, while the wealth of the bottom 50% remained essentially flat. That's not capitalism. That's not free markets. That's a rigged game, engineered at Jekyll Island in 1910 and enshrined in law in 1913. So where does this leave us? We're living in a financial system built on borrowed time, where every crisis is met with more debt, more money creation, more inflation, and more wealth concentration. The machine keeps running faster and faster, but the bill keeps growing. And here's what terrifies me. The system today is exponentially more dangerous than it was in 1913. Back then, the global financial system moved at the speed of telegraph wires and steamships. Today, it moves at the speed of light with algorithmic trading, instant global capital flows, and interconnected derivative exposure that spans every major economy on Earth. When the next crisis comes, and it will come, it won't unfold over months or years. It'll unfold over days, maybe hours. And the Federal Reserve's response will be the same as always. Create more money, bail out the banks, and pass the cost to you. The lesson here isn't just historical, it's philosophical. We're living in a system built on the illusion of stability, propped up by institutions we're told to trust, run by people who profit from our ignorance. The denial is comfortable, the truth is terrifying, but denial doesn't change reality. It just delays the reckoning. The Federal Reserve was born in secret, designed by private bankers, and sold to the public as a necessary protection against financial chaos. But the chaos never stopped. It was institutionalized. The crashes keep coming, 1929, 1987, 2000, 2008, 2020. Each one met with the same solution. More debt, more money creation, more control in the hands of the very people who caused the problem. And every time, the wealth flows upward. Every time, the middle class gets smaller. Every time, the gap between those who own capital and those who sell their labor gets wider. The stakes now are existential. We're not just talking about recession or inflation. We're talking about the potential collapse of the dollar as the world's reserve currency. We're talking about a level of debt that can never be repaid. We're talking about a system that requires infinite growth on a finite planet, backed by nothing but confidence and force. The question isn't whether the system will break. The question is when and how catastrophic the fallout will be. So here's my challenge to you. Share this video with someone who still believes the financial system is working in their favor. Send it to someone drowning in debt who thinks it's their fault. Post it where it makes people uncomfortable. Because the only way the system changes is if enough people see it for what it is. Hit subscribe if you want more of these deep dives. Leave a comment and tell me, do you think the Federal Reserve should be audited, reformed, or abolished entirely? I want to hear your take. And here's the final question, the one that matters most. Are we wiser now, or are we just walking the same path in better suits, with faster computers and bigger lies? The answer will determine whether we break the cycle or repeat it. Thanks for watching. Now go share this truth.